Thank you, Mark, and welcome everyone. Great to see a lot of familiar faces in the audience and a great turnout as well on a pretty warm day walking up the hill. Talking about equity income, but of course the all-important disclaimer, don't trust me because I'm a doctor, your past performance, etc. And please don't choke on your food. There might be 4 doctors at Plato, but 3 of us have PhDs in finance, and the other one is a rocket scientist because he's got a PhD in astrophysics. So don't choke on your food. Start with the big picture because I think the big picture has changed dramatically in the last 3 or 4 months, actually. It was really December, I think, when markets started to realise what we've been saying for probably the last 6 months was we're at or near the peak in interest rates, and I'd say now we're at the peak in interest rates, but I haven't changed the title for about 6 months. And why are we at the peak in interest rates? Well, because despite even Phil Lowe continuing to say that inflation is, could be sticky, doesn't look too sticky to me. It's come down quite rapidly in just 12 months from 7.8% in December 2022 to 4.1% for the December quarter reading. But the latest 2 monthly readings are 3.4%, which is only a little bit above the RBA's 2 to 3% guideline. And both the quarterly and monthly numbers were below RBA expectations. So it seems to be quite coming down quite fast. And a lot of the feedback from companies this time around was not about wage inflation, which was last year's story. They actually think they've got a handle on costs and margins. So it looks to me like inflation is coming down. So that means that interest rates are probably at their peak. We've already seen term deposit rates, longer dated ones, actually start to come down already as markets factor this in. So it's about as good as it gets for interest rates. Yet it was only in the December quarter that real rates of cash rates actually became positive. For the last 2 years, they've been significantly negative because inflation was running harder than interest rates. So it's about as good as it gets for term deposits, which was good for us because we've been generating something around 8.5% to 9% income from our Plato Australian Shares Income Fund when you include the franking, which of course for retirees, if they're in self-managed super funds or actually super funds and platforms anywhere, the first 1.9 million of their transfer balance cap should be tax-free, and they get a full refund of franking, which is great. And we try and make the most of that. And I suppose our simple philosophy is if we can generate, or your clients can generate enough income from the investments they have, it's a good way of having limited longevity risk because you're generating enough income and you don't have to start selling down assets. As Mark said, we unashamedly manage for retirees. I've shown this chart before, but here are tax-exempt or pension phase investors, but it's also charities, passives and those sort of things, or in fact, even people earning less than $18,000. You get a full refund of franking. So the black column there is the value of a fully franked dividend. What I'm looking at here is the value of after-tax value of $1 of pre-tax income or return, and certainly for pensioners, for retirees, and charities, franking credits, fully franked dividends are worth more than anything else. You don't pay tax on anything else, but you don't get a tax credit either. So that 42-cent tax credit on a $1 fully franked dividend is very important. It is the case, though, that it's still pretty good for 15% super. And even if we do have this 30% tax or the extra 15% tax on $3 million balances and above come in, fully franked dividends will still be best in super funds and far better than if you're in the top marginal rate there. But this chart is why we actually target investors in these sorts of investors, because we can then make decisions and investment decisions where we fully value franking credits for our retirees. To show you the value of franking, I've got a couple of slides here, but first slide actually is a bit depressing. And I did this because a couple of clients said to me, gee, Don, you got great income, but capital values for Australian shares haven't gone far for the last sort of 15 or 20 years. So I'll get to why I've got a 17.5-year chart in a minute, but for the last 17.5 years, I've tracked the capital growth on Australian shares, global shares, and US shares, the S&P 500. The black line is Australia, and we're actually ahead for the first 10 or so years, and we've lagged significantly in the last 10 years. That's the black line. The capital growth, if you just looked at price increases in the S&P 300 here has only been 3.3% per annum for the last 17 and a half years to the end of December. Global shares in blue have gone up double that, capital growth 6.6%, and US shares have actually gone up 8.9%. The Nasdaq's, I think, has gone up even more, but I've picked the S&P 500, 8.9%, which is a grey line at the top there. So it's a little depressing, put everything in global shares. Well, maybe not. That's just capital growth. Let's think about income, and Australia is a high-income market, partly because I think of our franking system encourages companies to pay out dividends. When you add dividends in, Australian shares suddenly jump up to 8% per annum. This is just cash dividends. Global shares increase to 8.8, so not as much because their yield's only just around 2%. And US shares only go to 10.6%, but still they're well ahead of everything else. But for retirees, they get the franking, and indeed accumulators as well in super. In fact, all Australian residents get the franking, but it's just a question of how you can use it. And here, suddenly, Australia looks a lot better. Our total return is now 9.7% per annum when you include the value of franking credits, which means we've exceeded the returns on global shares over the same period. I'm using indexes for all of these. And not quite, but we're catching up to the US, which is 10.6, but it's been basically the best performing big market in the world. Most people tend to invest in global shares, not just the US. And who knows whether in the next 20 years, US shares might be the worst performing of those three asset classes. But still, I think the motto is don't forget the franking, and just to highlight that, gone over it just to look at Australia back again, highlighting the value of franking. You don't even get $1 doesn't even grow to $2 when you just look at the capital value. It grows to nearly 4 when you include the cash dividends, and it grows to over 5 when you include the franking credits. So those franking credits and income is very, very important for Australian shares. Looking at the reporting season, just high-level stuff here. Wasn't all that bad, and in fact, I think a lot of people felt it was better than we expected because we expected it to be pretty bad. The average dividend increase was 6%, positive. The median, which is probably a better indicator of the average company, even though it sounds a bit silly, but was up 2.7%. What that means is more than, when you rank stocks from best to worst, the one in the middle, the 50th percentile, grew its dividends by 2.7% because we focus on dividends. And that means that more than 50% of companies increased dividends. In fact, 58% increased. 15% were flat compared to last year, and 27% reduced. And if you want to be the glass half empty, you'll focus on the very last column there, and it's a negative. The actual dollar value or market cap weighted value of dividends fell. Companies declared $35 billion worth of shares in February compared to $36 billion based on our universe of stocks, so down about $1 billion. But basically two culprits. BHP and Woodside, energy prices have come off, oil and gas prices, and BHP did have a few calamities itself. Obviously, nickel has been a disaster for anybody in the nickel business, and they wrote their assets off not just to zero, they actually wrote them to negative $300 million for remediation purposes, and another big loss in the Samarco disaster in the dams, etc. there with its joint venture with Vale. Looking at some of the individual details, we've been talking about the insurers for some time, and if you go within Suncorp, because it is an all-finance group, its general insurance profits are up 50% year on year. When you open up your premiums on your insurance, you probably go, oh my God, up another 10, 20, 30%. And they're also taking that higher premium and they're investing it in higher cash rates, so they're making more money. Not all good for Suncorp though, because you'd also see their banking division was down 25%, which is a pretty big fall in the period. But you are probably aware they're trying to sell it to ANZ. That's just been approved on appeal. And if you're trying to sell something, I don't think you're paying too much attention to it, and they definitely didn't. So they hopefully will sell that and return some capital to investors. But QBE, pure insurance play, up 100%. So that was very good from our point of view. And even though BHP was a bit of a damp squid, so to speak, Rio increased its dividends by 20% because iron ore prices up until very recently have held around the $130 a tonne. And Fortescue is up 40%. Not only is it benefiting from higher iron ore prices, but it's also reduced capex into those green energy ones. It's only going to now make investments if they actually make economic sense, which means they're starting to talk economic sense themselves. But the one that I really like, because I was on Livewire and talked it up just before the reporting season, was Ampol, and they came out with a 14% increase in normal dividends, and on top of that, a 60-cent special dividend, fully franked. We were hoping they would do that because they've got heaps of franking credits and they've been doing this in the past. They can't do buybacks anymore, so the only way they can get the franking credits out is to pay special or ordinary dividends. And they don't have a lot of capex, so I think they can maintain a pretty high ratio. And just as an anecdote, I was at they're actually doing very well out of their sales of other things, not just petrol. I went to the service station a couple of weeks ago, and my petrol bill was $150. The guy in front of me, it was $250, but he'd spent like $100 on candy and drinks and things for his couple of kids and himself, and it's like, wow, then the margins I make on that is ridiculous. There's always lowlights. Pilbara, anything to do with nickel or lithium got caned. Pilbara didn't pay a dividend at all. Big cut from South 32, and I think actually it's almost the end for Magellan. AG, I think they've bottomed out and they're starting. They can't really lose much more FUM, so I think they'll do better going forward. But lastly, in my last 30 seconds, what is our outlook? Let's talk about thinking forward, going forward. I've shown this slide before for the last few years. Part of our process is to avoid companies where there's a high probability they'll have a big cut in their dividend. So bottom up, we forecast companies that might cut dividends. It's a probability. The higher the probability, the worse the problem. So that's a really bad point, which was the pandemic, April 2020. The previous high point was a GFC, which is obviously pretty horrible for dividends and returns in total. Interestingly, after we realised the pandemic wasn't as bad as we thought, this collapsed to a good position. Below the line is good, and we had big dividend increases in 21 and 22. As interest rates bite, this probability rose, which is slightly negative, but it never got too far above the long-term average. And in fact, in the last 3 or 4 months, has actually dropped back towards that long-term average. So in my view, the dividend outlook looks pretty good. So I would encourage anyone with retirees to think about the Plato Australian Shares Income Fund or the listed version PL8 for those retirees, because it is a strategy dedicated for them. Thank you.